Have you ever wondered? Some people spend 30 years paying off a mortgage, while others finish in less than half that time without earning more money. John was one of those people. He wasn't wealthy. He didn't receive an inheritance. He didn't start a business. And he never got a massive promotion. Yet, somehow he paid off a 30-year mortgage in just 11 years. Not 20, not 15, 11. And when he finally added up the numbers, he realized he had avoided more than $250,000 in interest. That money stayed with his family instead of going to the bank. His friends thought he had discovered some secret investment. But the truth was much simpler. John learned something about mortgages that most homeowners never understand, something hidden in plain sight. And once he understood it, everything changed. Today, I'm going to show you exactly what John discovered. You'll learn why banks love 30-year mortgages. Why most homeowners unknowingly spend years paying interest instead of debt, and the simple strategy that can dramatically shorten the life of a mortgage. Let's begin. Most people think a mortgage is straightforward. You borrow money, you make monthly payments. Eventually, the house becomes yours. Sybil, at least that's what most people believe. But hidden inside every mortgage is a system called amortization. And this is where the story changes. Imagine you borrow $300,000 to buy a home. Every month, you send a payment to the bank. You feel responsible. You feel productive. You feel like you're making progress. But here's what many people don't realize. During the early years of a mortgage, most of that payment doesn't reduce the debt. Instead, it goes toward interest. Month after month, year after year, many homeowners spend the first decade making payments while the actual loan balance barely moves. Think about that for a moment. You wake up early. You work hard. You sacrifice weekends. You send thousands of dollars to the lender, yet most of that money never reduces what you owe. The bank gets paid first. You get progress later. And that's not an accident. It's how the system was designed. The moment John discovered this, he stopped thinking like a borrower, started thinking differently. He realized something important. Interest is calculated based on the remaining balance. The larger the balance, the more interest you pay. The smaller the balance, the less interest the bank can charge. That sounds obvious, but the implications are enormous. Every dollar that reduces principal also reduces future interest, not once, not temporarily, forever. Think of it like removing a branch from a tree. The branch never grows back. Future interest can never be charged on that dollar again. This is where John found his first breakthrough. Focusing on the monthly payment and started focusing on the principal balance, because that's where the real battle was happening. Then he discovered something even more powerful, a strategy known as bi-weekly payments. Most homeowners make one mortgage payment each month. John divided his payment in half, then paid every 2 weeks instead. At first, it seems like nothing changes. Same house, same mortgage, same income, but the calendar tells a different story. There are 52 weeks in a year. That means 26 bi-weekly payments, which equals 13 monthly payments instead of 12. Without feeling a dramatic difference in his budget, John was making one extra mortgage payment every year, one extra payment every year, year after year. That single adjustment began removing years from the loan, and every year removed eliminated thousands of dollars in future interest. The beauty of the strategy wasn't complexity, it was consistency. Small actions, repeated over time, creating massive results. But this next discovery was even more important, because many homeowners unknowingly make a critical mistake. They send extra money to the lender and assume it's helping. Sometimes it does, sometimes it doesn't. The problem is simple. If extra funds are not specifically directed toward principal, they may be treated differently depending on the lender's process. John learned to ask one question every single time. Can this payment be applied directly to principal? That question changed everything. Every bonus, every tax refund, every unexpected payment, every extra $100 went directly toward reducing the loan balance, not toward future scheduled payments, not toward future interest calculations, straight to principal. And every time the principal dropped, future interest dropped with it. The effect wasn't dramatic at first, but over time, it became unstoppable. The mortgage started shrinking faster, the interest charges became smaller, and the gap between John and the bank kept growing. Then he added 3 simple habits. The first was rounding up. If the payment was $1,842, he paid $1,900. Nothing extreme, just a small adjustment. But small adjustments repeated hundreds of times create extraordinary outcomes. The second habit was using raises wisely. Most people earn more money and immediately increase their spending. John chose a different path. Whenever his income increased, he directed a portion toward principal first, before lifestyle inflation could consume it. The third habit was surprisingly simple. He reviewed his mortgage progress once every year, not every day, not every week, just once a year. He looked at the balance, compared it to the previous year, and watched the numbers fall. That simple habit kept him motivated, because progress creates momentum, and momentum creates consistency. Eventually, John realized something most people never learn. Financial freedom rarely comes from one dramatic decision. It usually comes from small decisions made repeatedly for a long time. Now let's talk about what you can do, starting tomorrow. First, log into your mortgage account. Find your current principal balance. Write it down. That number matters. Second, contact your lender. Ask whether principal-only payments are allowed, and ask exactly how they must be submitted. Don't assume. Verify. Third, ask whether bi-weekly payments are available. If they are, consider enrolling. If they aren't, explore whether making additional principal payments throughout the year could achieve a similar result. Fourth, make one extra principal payment. Not next year. Not someday. This month. Even $50 matters, because the amount isn't the point. The habit is. And finally, track your progress. Watch what happens over 6 months, 1 year, 3 years. You may be surprised by how quickly small actions begin to compound. John's story wasn't about luck. It wasn't about a higher income, and it wasn't about working harder than everyone else. It was about understanding how the system worked. Once he understood the math, he stopped helping the bank win and started helping himself. The truth is, the mortgage system rewards knowledge. The more you understand it, the more options you have. And while most homeowners focus on making payments, a small percentage focus on reducing principal. That difference may seem small today, but over years, it can mean thousands or even hundreds of thousands of dollars. The clock is already running. Interest is being calculated every day. The question isn't whether these principles work. The question is, what will you do with this knowledge now? Because the sooner you begin, the sooner the balance starts falling. And the sooner the balance falls, the sooner your money starts working for you, instead of the bank.